I'm going to kick it off. Thank you, Megan. Since I have a few minutes to just do a quick introduction before we dive in. So thank you everyone for joining. This is one of my favorite sessions, our monthly Startup Advisor AMA. This is the first one. So I'm Rochelle Stewart. I'm co-hosting this along with my colleague, Megan Williams, and really excited to have all of you here today. So for those of you who don't know, I lead the New and Strategic Channels team at SVB within the Startup Bank. So I have the pleasure of working with all pre-Series A startup founders. Some of you I know well because you're part of some of the partnerships and fellowships that we've supported. Our team supports all founders, but we particularly care and support the mission of diverse founders and underrepresented founders who often don't have spaces like this where they can ask honest questions and get honest feedback, but also just having a real discussion without judgment, with a forum where you can really learn from the experts. So the spirit of the Startup Advisor AMA is to have folks who are truly domain experts, have been working with founders and know their lane well. And I think none other than Wendy to join us. I've known Wendy personally for many, many years. She actually helped me to launch my angel investor syndicate years pre-SVB, and it's such a pleasure to welcome her here, not only to speak with founders about term sheets, legal, just helping you understand sort of navigating that path of fundraising and doing it the right way the first time, especially since we have a lot of first-time founders on the call, but also because she just launched her own firm and branching out on your own to really do the work that you love and are passionate about. We support that through and through. So with that, I'll say I'm excited to talk about this topic with Wendy. I'll allow you to introduce yourself, share your narrative, and then we'll dive right in with some questions and look at the slide. Use this one slide that we have that I didn't mean to have up that whole time. I just realized one slide that we have to talk about to help guide the conversation in the framework. So Wendy, with that, say hello to the crowd and please introduce yourself to the audience.
So great to meet all of you. And I see some familiar names, some clients and friends and folks I know in the ecosystem here, and lots of you I don't yet know. So it's great to meet you. I'm apologizing in advance. This is my dog's witching hour. So if you hear some barking, forgive me. Anyway, yeah, I'm an attorney. I've been an attorney for quite some time. I started my practice at a huge law firm, really on the IP side. So I always think about IP in everything I do. I did corporate work there under kind of the IP umbrella, which meant I worked within the corporate department doing IP work. I worked within the IP department doing corporate work, and then actually took a pause from practicing law for a handful of years when my children were really young, and dabbled at a startup myself, worked in a nonprofit, and really focused on my family. Came back to practicing law and jumped right into this sort of startup ecosystem because I had become an angel investor and just found the space really interesting, and certainly tied so much in with what I had known before, but allowed me to have the kind of practice that I wanted, where I got to really be more of an advisor to my clients rather than just working on huge mega deals where you're just handling one teeny little piece. Got to know Rochelle, like she said early on, and we've been fortunate enough to know each other for a long time. So my practice has been for quite some time working predominantly with early stage companies. I do work again in the IP space with some larger organizations. But this summer I left the boutique firm I was working with and launched my own firm, predominantly to be able to serve the types of founders and clients I wanted to serve, focusing really in an underserved space, and also to practice the way I wanted to practice and to really bring a very thoughtful, patient presence to my clients and to their needs, and really listening and partnering with my clients more than just kind of shoving a platform at them that can sometimes happen. So it's been a wonderful ride. I have also stepped in the shoes of many of my clients, getting to be a founder myself and really seeing the ups and downs of that absolutely firsthand. It's like when you've been a babysitter forever and you say having a kid's going to be easy. So you get to actually see it all in a different light. I'm so excited to talk to you guys today. And our topic, we said term sheets. We said we're going to talk about IP. I always say when I first talk to a client, brand new company, corporate formation, IP, employment, there are some of these pillars that are really early stage. So the IP ties in. We'll talk about that kind of second, I think Rochelle and I decided, but we'll start more with term sheets since that's kind of what we're leading with. I saw some questions were already placed. Some of you, when you signed up, you popped a question in there. So we'll make sure to highlight those and get to those. I see a few questions popping up in the chat. Feel free to pepper the chat with more questions. We won't pause for questions until later, so we can kind of get through some of the content and focus on some of the big picture themes and things we think will apply to everybody. And then we'll do our best to dig into questions, try to keep the questions broad. I should say I'm none of this is legal advice. I'm not, I do see a few clients here. So for those of you who are clients, of course, I am your attorney, but for the most part, I am not representing folks on this call, and anything I present is my thoughts, is not legal advice to you. You should seek your own legal advice from an attorney, and we'll go from there. So Rochelle, should we jump in? Do you want to, yeah.
Yeah,
Okay.
so I'll go to the slide that I already previewed, and everyone's probably reading it and not listening to me. So I appreciate that qualifier as well. This slide actually comes from our fundraising workshop, which we also do once a month. Some of you may have attended. And usually what we talk about and why we use this is because we recognize that, founders are often asking a couple of the same common questions, like what size is a pre-seed round? Like, what should I call this round? Like, what do investors care about when I'm raising the seed round? And for this session, what we're really going to focus on is a bit complementary to that. And it often isn't something we spend a lot of time on because it is so nuanced and it does vary founder to founder and company to company. But it is important to get a start and at least feel grounded in that you understand legal structure, legal terms, and can navigate that fundraising maze with a little bit more conviction that you know what you're getting yourself into. So with that, education is, a gift in that respect. And what we're really trying to hope that everyone can walk away with is, if you look at let's just start with pre-seed, because we have, I think it was roughly 60% of the audience that RSVP is at the pre-seed stage. If we skip to sort of thinking about rounds, if we skip over the round size, let's talk a little bit about structure and the fact that there typically is a set of just standard ways to talk about pre-seed rounds and standard structures. And as you see here, we have safe and convertible. What we won't do is assume that everyone knows exactly what that means when they're going and thinking about and considering, I'm raising a pre-seed. Do I raise on a safe or do I raise on a convertible note? So we actually want to start there with just the basics. When you're thinking about structure, if you're at the very early stage, day one, I know I need to fundraise. Let's say I'm asked, oh, well, what are you raising and how are you raising it? How do you help founders answer that question?
Yep, it's a great question. And I'll start by saying I love this slide. I think it just lays it out so clearly and simply, and you even give this indications of sort of what you should be expecting to pay in legal costs. So at the pre-seed stage, you're usually doing what is often called a debt round, they call it, instead of an equity round. So you are in theory selling equity, but you actually aren't. Safe and convertible note are the two standard forms, and neither one of those is actually creating stakeholders in your company. You're not actually giving anybody any real equity in your company. You're giving them a promise to offer them equity later, but they're not actually on your cap table. If you use Carta or you've created your own more sophisticated cap table, you probably have what's called a pro forma cap table, fully diluted, where you actually can see what it will look like when they convert into equity. And that's important. And we're going to talk a little bit about that. But just for the actual facts of the matter, you won't actually have any additional stakeholders. So you could raise 2.5 million on a safe, and you could still be the only shareholder in the company. So just to keep that in mind. So typically at this stage, you are doing that type of raise. And there's a number of reasons for that. And one is literally, look at this, dollar costs, legal costs, $1 sign. So you're not having to spend as much on your legal, which you shouldn't be spending a ton on your legal at this stage or building your business. And and there are a couple of these forms out there that are really common. I saw one of the questions when in the RSVP was where to find these sort of template documents. The safe is simple. Y Combinator. Y Combinator is one of the top incubators, and it's some time ago, 10, 15 years ago, they came up with this idea that, hey, instead of always doing a convertible note, which a convertible note is essentially a promissory note, it's just saying, instead of you paying me back in cash, you're going to pay me back in equity. We're all pretty familiar with what a promissory note is. Convertible note is essentially that same legal structure, just reconfigured so that the lender, is agreeing to be paid in equity. A safe is structured a little more around a warrant concept. So without getting into all the legal nitpicks. It's just a different structure with the same end result. So for founders, you're looking at more or less the same end result with either one of these documents. One question I sometimes ask at this stage is, who are your investors? If your investors are typical VC type folks, so maybe they're angels, maybe they're micro VCs, maybe they're strategic partners you've met through the ecosystem, they're probably going to be pretty comfortable with a SAFE. I do see for some clients, when they go out with a SAFE and their investors are more traditional investors that are not VC types, so maybe real estate, maybe you're looking at somebody who's much more used to a particular geographic, investing more locally in a particular geographic region that's not a VC hub. I actually had a client just recently, we got very far along with getting the SAFE together and getting it out to the investor. And this particular investor, who's an ultra high net worth individual, had their lawyer like laughing at me on the phone when I was explaining a SAFE, because this, man that's been practicing law for 30 years had never heard of it and didn't understand how this was acceptable in our ecosystem. And because there's no interest, there's no permission for really clawing back the loan, which it really is essentially a loan. So he made us move over to a convertible note. So if you have those types of investors, you might want to right out of the gate say convertible note is going to be our friend. Safes are probably a touch cheaper, a touch easier for a founder, because you literally just use that Y Combinator. I would still have a lawyer make sure you're populating it correctly, make sure your company board gives authorization to release that SAFE out into the wild and take investors. So there are a few things your lawyers need to do under a SAFE, but it's a relatively low lift. Convertible notes are similarly, like your lawyer should have a template that they use. There are a lot of templates floating out there. I'm sure if you typed into the internet, you could find one. But so you guys hearing an echo on me? All of a sudden I had an echo. But it's again very similar end result for you. You're taking money in, you're going to pay them back with equity. Convertible notes usually have interest as well. That's something to think about. Simple interest around 5% is what we usually see. I saw a question about interest in there. And just jumping back to our theme here, term sheets. You don't usually have a term sheet at this stage. Once in a while, I've seen one. It's not going to say much. More or less what your term sheet is a page on your slide that says you're raising $1 million and your terms of your raise. So are you doing a val cap? Are you doing a discount? And that's probably something we can touch on too. What are you planning to use that money for is really important. That's obviously not the terms, but that's important. There's one other term that may not show up in your deck, but is important to either talk to your lawyer about or have a sense of, maybe talk to your advisors. What will be the triggering event? What's the qualified financing that will turn this loan into equity? And if you're raising at a pre-seed on $1 million, maybe it's a couple $1 million. So basically you're saying, when I go to raise again, what number do I have to raise in order for your loan to turn into equity? And that's the qualified financing number. So when you think about going up this hill on the slide, at what point do you want that to trigger? So you may not want that to trigger at your next round, because your next round, if you look down here on this SPV slide, note or priced round, sometimes you're going to do another note. So if you're going to do another note in a year or two, and you may not know, so it's tricky. And this is why it's important to have these conversations with an advisor. But if you're going to probably do another note, you actually don't want that note to trigger your original note converting. Now, they're structured in such a way that it should really just be at a qualified financing that is actually selling shares. So you really wouldn't trigger until probably the third box here, the Series A. But just so you have a sense, so what happens at that Series A is a priced round. Down here, you see that legal cost, $3 signs. It's much more expensive. But you're swooping and you're collecting all of these debt financing folks, and they're converting into shares. And then when you walk out of the Series A, you all of a sudden have lots of shareholders. You have the folks who invested at Series A, and you have anyone who invested before that. And you don't have to have a pre-seed and a seed and a Series A. You may only have one or two of these rounds, or you may have 5. You may have a lot of these. Sometimes there's bridges, and we come up with different things as companies need them.
Awesome.
Should I touch? I don't want to get too deep in the weeds on anything because I know we have a lot to cover. Should I touch on terms, sort of like the val cap and the discount, probably helpful, and then we can move on?
I think what would be helpful too, I would say, this is all really great. How much control, like just putting yourself in the founder seat, what do you act like day one, you're raising that pre-seed round. what do you actually have control? Like, where is the negotiating power truly live, right? Like, as often you hear, like, this is a founder-friendly market, an investor-friendly market. And let's just be honest, like we can't ignore the current market environment where, investors are in many ways behaving differently. It doesn't mean they're not investing, but the way that they approach it is different. And that's true too for angels, early stage friends and family. So for any of the founders who are saying, well, I'm having a lot of conversations, I'm getting a lot of questions from my investors. They're saying, oh, well, like, where do I actually just kind of have the ability that I can just take control and say, here's what I'm going to market. And I've seen founders who just don't always feel comfortable that they can just put it on a slide and say, this is what it is, versus looking for the investors to give them some guidance. So would love to hear more on that from you before we go to the next question.
Yeah, and that's actually the same. I mean, it's talking about those terms, and that's where it's helpful to have, some sounding boards. And you probably, as early stage founders, have some advisors. Of course, you have friends, family, other folks. Nobody's opinion is going to be gospel. It's really what can you get them, who can you convince that this is the right terms? And that's where your leverage and your negotiation, I guess, comes in, is just where you set these terms. You don't typically see a lead at this stage. So the lead is usually who you're negotiating with later on. And so it can be really tricky. You're pulling these numbers out of the sky, and it can feel very overwhelming. I think there's really two numbers you're coming up with. One is how much you're going to raise, and two is what's the price of that? Like, what are you setting that at? Is it a discount? Is it a val cap? What number are you setting that at? Is it both? So the first one is easier to come to, I think, where you typically in a market like this, I would say give yourself at least 18 months of runway. You don't want to go out raising more than once. If you can't fill the round, then maybe you tell yourself, okay, I'm going to close at 12 months of runway, knowing that I probably need to raise again in 12 months. And sometimes that's smart because, if the market can't support where you're setting your valuation, then maybe you raise a little less and sell a little less of your company at this sort of lower price. And hopefully you've got traction, you've proved more. And so a year from now, you can raise it higher. But I think 18 months is a good number to come at. So run your numbers, get your budget out.
Have zero? So it sounds like you're saying, if I have 0 months runway today, I'm just getting started, I need to be in market. I should be aiming to raise what I think I need for 18 months. That's how you get to your, roughly speaking.
That's what I would do. And the nice thing about a SAFE or a convertible note is they're rolling. So the minute someone says, hey, I'm going to write you a check for $10,000, you can put that in your bank. You don't have to wait for a close like you would with a Series A with a lead investor.
That's an important distinction. Yeah, this idea of being able to fundraise on a rolling basis, because I do think founders sometimes feel overwhelmed thinking, I'm raising 2 million, I have to raise it all in the next 3 months. Like, if you are doing it on a rolling basis, you can say, hey, it's open now, it's on a SAFE, and I'm okay if, to fundraise in 3 months, 6 months, the SAFE is still exists. So is there ever, like, how do you think about advising on closing a SAFE? Like, what does that mean for a founder?
Yeah, I think two things. I think once, it's very time consuming and can be very emotionally and physically draining for a founder to be fundraising all the time. So I think you have to give yourself a mental bookend there. I also think if with a straight face, you can say, my company is still worth the same today as it was when I opened this SAFE, like, there's no issue. But if you're talking about 6 months, and you're really early on, your company's going to change a lot in 6 months. Right. So what your company was, the terms that investor A got on January 1st
should look different.
Investor on June 1st should look different, right? So at some point we should close that SAFE, give ourselves some air, even if it's only 6 or 8 months, reopen. Sure, you can create another SAFE and increase your terms, even if just a little bit, even if so you're giving that January 1st investor a little bit of a leg up. So they got the valuation cap at 4 million. Well, now you're saying your company's worth 5 million. It's not huge, but that's going to matter when you convert everybody, how many shares they get. The January investor gets her money into a $4 million company. The June investor gets their money into a $5 million company.
5 or 6 million.
So yeah. And again, that number that I came up with, that 5 million for, I made it up. And that's how it's actually done. There are a million things you can find if you Google this sort of stuff, but it's not, it's whatever the market can accommodate. And I know that's not helpful.
Right. But I appreciate you saying that. I think we don't have valuation on this slide, but I think that we say, similarly, you might hear from, well, I'm so worried about the valuation. And it's kind of difficult to hear. It doesn't matter when we know it matters, but it's particularly at the pre-seed stage, there's a range for valuation. And if your investors feel comfortable with that range, that's what it is. So as long as it's within the wheelhouse of possibility and, 3 million, 5 million, and you're not undervaluing yourself like that we've seen. I don't know if you can touch on that just a bit. I think it's important, especially pre-seed. I have seen scenarios where the founder has committed and undervalued themselves, like one who's actually at a Series A now, and her very early investors got in at like a 2.5 million like valuation very early. And she was,
It's huge. And this is where I think we're going to share the link for this. If you're not on Carta, founders, which is fine. If you want to be on Carta, get on Carta. It's a great platform. But if you're not on Carta, there's Rochelle can drop it. There's a wonderful venture fund, 645 Ventures, and they've created this little tool that you can use to play with dilution. Because what happens in that scenario Rochelle played out, when you get to your Series A, anyone who invested in a convertible note or a SAFE at your pre-seed on a $2.5 million valuation, they're going to convert at a $2.5 million valuation. So we're not actually talking about the valuation of your company. Let me clarify. It's the cap. We're saying this is the cap at which we will convert you. So if my cap today is 4 million, no matter whether my company's worth 100 million or 6 million, you get to convert at a 4 million cap when we convert. So if I've had tremendous growth, and in this situation Rochelle played out, even with not crazy tremendous growth, if you're converting at a 2.5 million valuation, that's tricky. I think this little number down here, which I don't always see in these conversations with the carrot, 10 to 20% dilution. So that's actually helpful. So this could help you get to your numbers a little bit, I think. So if you say, I need $500,000 for 18 months, really low. Let's make it $1 million. Let's make it a little bit easier. Let's say I need $1 million.
You want to share as you're talking through it?
Sure. Wait, what am I sharing?
Oh, I thought you were using the simulator.
Oh, no, which would be fun, but I don't know if I'm ready for that. I was just looking at your slide.
Oh, got it. Yeah, that makes sense. Okay, yeah, I think.
No, that's okay. That's
back
okay.
to the slide.
No, I was saying, because you said 10 to 20%. So I think that's a way to think about this. So if your company needs $1 million, you don't want to raise on a $4 million valuation cap, because that means you're selling 25% of your company. That's the math. If you raise that full million, all of those investors are going to have that $4 million valuation cap term. So whenever you convert your company, they're going to convert at that price. So if you need $1 million, you should set your valuation cap above 4 million, so you can stay within that sort of 10 to 20% margin that SVP has put on the slide.
Yeah, I think that's important, because what you mentioned is like dilution. It's not technically dilution because you're not being diluted in the moment, but you're really forecasting future dilution based on your, like, the dilutive impact when you do convert to equity. So, and I know it's nuanced, but it is important to understand that if you are raising, and Wendy mentioned, it's considered debt because it's like if it goes to zero, there's no recourse. So like you don't owe anyone anything. If they invest $1 million and it all goes to zero, you don't owe them anything, right? So, and it's the promise that if things go well, you now will own something and it will be converted at this valuation. And when you do convert at that valuation, it has implications for how much you as the founder are left with in terms of ownership of your company. So it's all theoretical and conceptual. And this is why it pains me when I hear folks on panels who are like, oh, don't overthink it. Don't worry about the cap table. I'm like, get an Excel sheet, use the simulator and understand the implications of what if I raise X, what if I sell, what if I convert in 6 months, what does it look like if I exit? I mean, just know the math. And it seems overwhelming and complicated, but I think it's important. And I appreciate Wendy for using those distinctions from a legal side to the sort of practical side. Because on the legal side, it's technically not equity, but on the practical side, it obviously means it will be if things go well. And that's what you're really solving for when you're fundraising.
Totally. And I think when you're doing these original rounds, it can feel like free money because you might not be looking at your cap table so clearly, right?
Yeah,
and
their
like,
founders won't even look at it. They're like, reel it on in. Just, yeah, totally.
Yep. And I think because it can be that much harder for diverse founders to raise, it can also be that much more just like, let me turn a blind eye to this and just, I know it's gonna be hard to raise. Let me just focus on getting the money in the door.
Exactly. 100%. And I think that's where you want to have the confidence to say, you know what, I want to understand what's happening with, the ownership of my company. And we do talk a lot about that ownership, and just if access and opportunity is the way to unlock, wealth and building, entrepreneurship as the path to wealth, certainly won't get there if you don't understand ownership, and that piece of it is really critical. So that could be a whole session of its own, a cap
Totally.
table and ownership like deep dive.
Which would be fun. Totally. We could like do a little, use the simulator and play out some models and see what happens
Right.
when we dilute.
Exactly. Exactly.
Before we move on, I was going to say, because the other number that we often see is this discount. And just so that I could explain that, because that can be helpful here. So it's either or, it's ValCap or discount. And interestingly, the SAFE, which used to offer both, really, and you see them around, and there's nothing wrong with putting out a SAFE that would offer your investors the better of. We're looking at your teams now, Rochelle. No, that's okay.
I was like, what is that?
Busted. But I don't think you want us to all see what you got going on.
Yeah.
So if you want to do just a discount, the way to think about a discount is like a coupon. So you're offering a coupon off of your future round versus the valuation cap. It's still dilutive. It's all the same. But if you're not ready to set a valuation, you can use a SAFE that only offers a discount. And some investors love it. Some investors hate it.
I feel like
some founders love it and some hate it. Most investors what?
Well, just in terms of, what's more common, valuation or discount, ValCap or discount?
A ValCap, I think.
Right.
What do you think?
I believe so as well.
Yeah.
And then I think people like to go with the herd. So whenever it's non-standard, it's like, oh, well, why aren't you doing that?
Oh,
so
totally.
That's
totally.
just like, as an angel, I'm like, many who have said, like investors who will say, oh, it's traded on a discount. Like, I'm not going to do an uncapped note. You might hear that term.
Yeah.
And it's a hard no. Like, I don't want, because basically it means you're limiting your upside.
You're limiting your upside to 20%.
Yes,
that's right.
Exactly. Yep. So Nancy, you put a question here. You understand the discount, not the ValCap. I do think that's important for everyone else to understand. Yeah. And it is Safe Note seems through Y Combinator's discount. So what, Nancy, maybe I could just ask you, what piece of that is confusing? Just definition, economics of it, how it works.
Go ahead.
Sorry, I get your valuation, and and I also understand undervalued, but discount, I understand it's a coupon, like it makes sense. ValCap, what are you just saying? Like, what's their incentive and what are you offering them based on giving a ValCap?
Gotcha. Okay. So do you want to address that now, Wendy, or before we open it up, or should we?
Sure. Yeah, no. Yeah, sure. And I was going to say that Y Combinator now on their site, at least last I checked, which may have been a month ago now, but was you could get either use a template that was a ValCap or a template that had a discount. They did not post on their site the template for both. Of course, they're out there. I have one that I use. Everyone uses them. They're still fine. There's nothing wrong with using them. It's just for some reason Y Combinator has decided we're going to do either or. So just to make sure I understand your question, Nancy, you just want to understand how the ValCap comes into play in real life. Is that right?
Yes, thank you.
Yeah, sure, of course. So a ValCap is not actually a valuation. This gets really confusing. We're not saying what your company's worth today because, you're pre-revenue. Let's be honest, your company's probably worth like thousands of dollars, maybe hundreds of thousands of dollars if you've built some great technology, but you're not worth millions of dollars. What a ValCap is saying is, I think I'm going to be worth $4 million, $8 million, $6 million, $3 million, whatever my ValCap is. I think I'm going to be worth that when I go to raise my price round, when I set a dollar price per share for my company. And that's this Series A step. Price round. It's impossible to know, right? And so investors are looking for opportunities where they can invest this early. This is very risky time for investors to invest because unfortunately, the majority of very, very early stage companies don't make it. Breaks my heart to even say the words, but it happens. So investors need to know that the ones that make it, they're going to do really well on. And while they may not do really well in the Series A, maybe it won't happen until later. Since this is the stage we're talking about, we're going to focus on this zone. So they're looking for, well, I think this company, while it's saying its ValCap is 5 million, I actually think it's going to go to 10 and I'm going to convert and I'm going to get this great opportunity because I'm going to convert as though the company was worth 5, even though the company is actually worth 10, 20, 30, whatever it is. So what happens in real life there is my $10,000 investment that I made or $50,000 investment that I made in I signed a safe note. I committed $50,000. I gave you a check for $50,000 and I'm now a safe holder at $50,000. When you convert at your Series A, you're selling shares, however many shares you have, whatever the price per share is, it's based on the company being worth, let's just say $10 million. I'm going to get a lot more shares for my 50,000 than somebody who invests at the Series A for 50,000, because they're going to get their shares priced based on a $10 million company. I'm going to get my shares based on a $4 million company. Is that what I said, or did I say 5? Whatever the number was that I said. That's the terms that you set at your pre-seed as your val cap. That's what those investors convert at. So I might be getting double the shares of somebody who invests if you end up being worth 10. That's obviously a really fabulous upside scenario. But what we're saying is, you're setting right now for me a term that I can rely on you going above. I feel comfortable that you're going to go above that or meet that.
Right.
Hopefully that helps.
Right. Hence why a note basically means you get no of the upside. So if you sell it,
you get 20%. You get the coupon.
Right.
You get
20%. You're capped. Exactly. So you're capped at that upside, 20% discount. So if the company's worth $1 billion, you get your shares priced at it being worth 800 million, versus if you came in and you got a 5 million val cap at a pre-seed, you get your shares at the 5 million valuation, which means you basically get more shares. Given the math of share price times number of shares is total valuation. So yeah, lots of math here. We should have a spreadsheet session as
there's a lot of math. 100%. There's a lot of math.
I do. Yeah, there's benefits to talking about it conceptually as well, but and having the Excel, but I also think that, you know, these are great questions, and please, I'll ask Wendy another question and see where you want to take this before we open it up. I think it would be great to talk about kind of the legal costs for a little bit, just like as you're moving through, you know, at the pre-seed stage, I say a couple times, ask your advisors. So we know it's a group of founders. What if I don't have any advisors? It's just me. I might be a luminary fellow like Nancy, but what if I don't have any advisors and I'm just, you know, going it alone using Google to figure it out in Y Combinator? What should I expect in terms of legal costs? I mean, we love referring clients to Wendy because she's fair and reasonably priced, but not everyone operates that way. And, you know, some law firms are going to be expensive just because they have more overhead, not because they're trying to, you know, be predatory. So we'd love to level set on that and have you share that with others.
Yeah. I mean, if you're literally showing up and you're needing a safe or convertible note, the board consent to approve it. And one piece I will touch on, which is not really germane to this conversation, but is so important, is that your investors be accredited investors. And you can look that term up. It basically means that they have net worth of, I think it's $1 million excluding their primary residence, or they're making 200.
Uh-oh, you froze. Was it me? Oh no. Oh, it is Wendy.
No, she froze.
Okay. Hopefully we get it back.
When a founder goes at their own and it gets a bunch of investors that are unaccredited, simply because you then
Wendy,
no longer
you froze up just for a little bit when you were saying the definition, but so yeah, no, but you're back in full force now, so we're good.
Sorry guys, I don't know what happened.
Make sure your investors are accredited. There's a definition
make sure your investors
you can look up.
Yeah, the definition you can look up, and the reason it matters is because if you have unaccredited investors, you cannot be exempt from SEC reporting, and it's very expensive and onerous to do SEC reporting. And as a startup founder, you do not want to spend your money on that. So keep your investors accredited. Unfortunately, I know there's a lot of wonderful people out there who want to write checks, but we can't take them. Find other ways for them to help.
Can you just recap on the threshold?
Yeah, I'll drop it in the chat. You can look it up. I'm not 100% sure on this.
Like it's changed, so that's why I'm actually honestly a little sticky on it, because they've been sort of loosening the guidelines in order to allow others to be accredited. For example, if you work for a VC firm, you could be considered accredited even if you don't meet the income threshold. So I'll drop a link in the chat for that.
Thanks, Rochelle. And I think there's a lot of pressure out there to loosen them more, because especially for diverse founders, sometimes the ecosystems aren't, or the networks aren't as high net worth, because let's get into the institutional wealth issues of this country. That you're just boxing out the same people more and more. So we could, again, we'll have another we can have another session on
Going follow-ups.
But just to get to the legal costs, and I say all this to say, if literally all you need is the safe or the convertible note, the board consent approving it, and the investor questionnaire, all of which any lawyer that operates in this space should have beautiful templates. They should literally be able to be like, here, $500, here's your documents. However, that's very rarely the case. And I would not feel like a good lawyer if I did that for somebody I'd never met before, because we don't know who's on your board. We don't know if your company is organized properly as a corporation that can follow, like LLCs. LLCs really shouldn't be using safes. I mean, they can, again, like not germane for this conversation, but so if you're working with a law firm and you ask them for those, they know everything about your company. It shouldn't cost you a lot of money. If you've never talked to a lawyer before, expect to spend some money getting them your documents, letting them do a little, get to know you on your company, make sure you're kind of, we do corporate hygiene, I call it, make sure your board consents are up to par, et cetera. And that can be, several thousands of dollars, depending on sort of what's going on. We might uncover unaccredited investors came in the friends and family, and we want to clean that cap table up and blah, blah, blah. But at this stage, it shouldn't cost more than a couple $1,000s, let's just say, to kind of get yourself off to the races. Maybe it's 5 to 10 if you have a lot of mess. Maybe it's less than $1,000 if you just need the documents.
Yeah, that's really important. And I think, a lot of founders on the call might be participating in or considering accelerators. And accelerators are often doing, some equity exchange, 100K, 25K, I get X% of equity. So, a couple $1,000s at this stage, even if you're like, all I'm raising is 100K. I mean, you're building your cap table from day one, or the future cap table, right? It's a pro forma, right? Nothing exists today because your company is worth a made up number. We've already got past that. But when it's not worth a made up number, you want to be well positioned to say, who is on my cap table and what do I have left that is mine as the founder?
Yeah.
And so those $1,000, like if you're like, take it away, like think of it as money well spent. Would you advise similarly if someone's using AngelList, for example, which in some way displaces legal because they're doing a lot of that groundwork for you, like an AngelList founder RUV is a way for founders to just raise directly. Do you typically say, hey, well, you don't need me. Just come to me after you're not raising on an RUV. Does that replace it?
It may. I actually don't. I'm familiar with AngelList, of course. I haven't looked at the terms of that. I think if you have a lawyer you're working with otherwise for things like IP, employment, et cetera, I think it would behoove you to have your lawyer just kind of have some eyes on that. If it's the
always
only thing
put
you're
your
doing,
eyes on it.
Yeah.
No matter what.
Yeah.
Okay.
Yeah.
That's a takeaway. So. Even if it's a few $100 just to say, hey, just look at this and tell me if anything looks, trust no one. Okay. So, so we have 20 minutes left. I'll open it up to questions. And then we do have a few that are here from the chat that I can kind of pop in to ask, but just giving folks the opportunity to come off mute and ask whatever's relevant to your business or any terms we discussed. I'll keep the slide up as well. Anyone? Don't need to raise your hand. You can just come off mute.
Yeah, since the ecosystem has changed with where we are in overall, I guess, economy, the thresholds that people are putting on their valuations, like 7 million or 5 million at a pre-seed level, has that adjusted a whole lot, or is that basically static for based on where you are in the economy, or has that adjusted as well?
You mean like have the val caps in general come down?
Yep, exactly.
I think so. Yeah, I think the pressure brings val caps down. If that's where we say it's a more investor friendly, investors can find deals a little bit more easily because the val caps are down. I think that's fair. I don't have definitive, numbers. I'm sure you could find them out there. There's places that track these things.
Yeah, and we have a startup report that goes through that, and I would say directionally we've seen just valuations in general go down, and then the val caps I think is a subset of that in terms of just how to think about it. So
because your valuation, so we talk about val cap in these early debt rounds, and then when you get to your Series A, it's an actual valuation, and we didn't even talk about term sheets, Rochelle. So when you get to your Series A and you're negotiating a term sheet with your lead investor, that valuation is a number you're coming to together, and you're working together to look at all the factors that we discussed, and you're looking at the market, and you're looking at a lot of things to say, this is the valuation at your Series A, your Series B, at your Series C. So Silicon Valley Bank is saying, we're putting together a report where we're looking at all of the valuations and these val caps from the very early stages, the valuations that are set for later stages. And we're coming up with, yes, the numbers are down a little bit since the economy's correction.
Got it. Thank you.
Yeah.
Great question. All right, guys.
Hi, my name is Gio. I had a question regarding SAVE. So I applied for this accelerator, And they basically said that the upfront save was 125,000, post money save. But then they give you a second portion, and the second portion was uncapped with a most favored nation. So I wanted to see if you could kind of, elaborate on what that provision exactly means.
Yep. I'm not going to get into the specifics on your specific situation, but I will say two things on that. One, I'll talk about most favored nation, and then two, we can touch on just this idea of safes with accelerators that Rochelle sort of touched on. So what a most favored nation clause means, and you see these in term sheets, is that if during this round, or if the company gives somebody else better treatment, we get that better treatment. Meaning, if they agree to a safe where you're like, sweet, I got a good deal. They agreed to this like 10 million val cap. Awesome. Now I'm going to go and sell safes to my friends at a 4 million val cap because that's actually what's appropriate. But I gave those guys a 10, those, losers, they fell for it. When they find out you gave the 4, they get the 4 too. That's most favored nation. And then accelerators and incubators in general, taking equity in your company, I think is fine. But there are a lot out there that don't have a lot to offer. So, just vet them well. I would say I've seen both sides of this. So make sure you talk to folks that have been through the program. The program itself will probably give you some names, but spend some time on LinkedIn and see who knows who that went through it, that you can, speak to, that maybe isn't being sent to you by the program. There are some big, well-known, programs, of course, but I think it's still helpful to get opinions just to find out what should you be focusing on? What should you be getting out of this program?
Okay, and real quick, so that's actually like continuous, right? Let's say you raise one amount, and the terms are different. It's gonna apply if they have the provision. But then let's say you go to another investor and you raise another round, it's still gonna keep applying, right? Like this provision is continuous, I guess, to say perpetual.
Yeah, I mean, in theory, your terms should be getting better, right? Look at the slide. They should be getting less investor friendly, if you will, as the company grows. The company can command a higher valuation because now you have 1 million users and your product is in, on the shelves of every CVS or, whatever it is. So now suddenly it's a much more, valuable product, valuable business. You can command a higher valuation. So that most favored nations clause, while it still stands, shouldn't come into play. What happens is if things go poorly and you were to have a down round, in theory, but it's usually really, it's more often applied in that near term, time zone.
Okay, awesome. Thank you.
Yeah.
Really great question. All right. Let's see. I'm just looking through to see if anyone appears to be ready to ask a question.
You could drop them in the chat too, people, if they're like somewhere where they can't talk, feel free to drop. There may have been questions in the chat already.
I'm looking back here. So let's talk about, I'm going to go to the question list for folks who are if there's not pro ratas in safes and how folks use them. So
yeah, it's I don't think it's default in the safe, but you sometimes have a side letter. I've had clients who've had investors. So a side letter would be, so I always say, don't give different investors different terms. You have one for this round. So if it's a 3-month round, or for Rochelle, like Rochelle's example, if for some reason you do keep it open longer or it's open for 1 month or whatever it is, everyone gets the same terms. Everyone's on the same safe, the same convertible note. You might find somebody who's like, I'm going to write you a huge check that's going to fill, you need $1 million. I'm going to write you a check for 500,000, but I want something special because I'm giving you a lot of money. At this very early stage, you're probably not putting people on your board. You might be giving observer rights, board observer rights. Later on, when you negotiate your term sheet for a Series A, your lead investor is almost always going to take a board seat. That's typically why they're doing that, why they're leading the round and taking that time, because they want to have that level of control and oversight of the company. But sometimes early on, you'll see a side letter. So a side letter to any deal, you see side letters all the way through any stage deal, is something special that investor is getting. And it could be in the typical things at the beginning stage you see are information rights, where they get the opportunity to see maybe it's quarterly financials, maybe it's monthly financials, maybe it's the ability to examine the books on notice. And then you might see pro rata. And occasionally you'll see, like I said, some board, some control. So like a board observer, sometimes you'll see, they'll say at the next round, we will take a board seat, but we're not going to take one now, that kind of thing. And pro rata basically means we have a right to maintain our percentage of the company. So if by investing $1 million in a $4 million valuation company, val cap company. I'm taking 25% of the company. I get to maintain that 25% at the next round. You don't usually see pro rata forever. It's usually just to the next round. So that means at the next round, if you raise $5 million, they get to, before you go out to anyone else on the market, they get the first opportunity to maintain their 25% of the company.
I had a question about term sheets for low equity stakeholders. So your advisors who are getting like 0.1 to 0.25, I want to give them something that provides some sort of like equity stake. And I don't know would that be on Y Combinator? I haven't seen it, but maybe I'm not looking right.
No, it wouldn't be on Y Combinator. It's a good question. So without getting too deep in the weeds on this one, typically the best way to do it is options. There are other ways to structure it, but options is the best way to structure it. And only corporations give options. So if you're an LLC, you can't do options, but if you are a corp, you can do options. And what I usually do is set companies up with an employee incentive pool, EIP, ESOP, you've probably seen, which is employee stock option pool. And it's not just for employees, it can be for investors, advisors, it can be for, sometimes I see deals with influencers where they're getting equity, things like that. And there is an example on, what's it called? Founders.
I was looking that one up. It's the same one.
With the
I think
F.
you and I spoke
Yeah,
about it before. Founder Fast or something.
FAST, that's it,
Yeah.
FAST, F-A-S-T,
I'm trying
thank
to
you.
get to my chat.
Yeah, you dropped it. No, Jeremy dropped it right here.
Oh yeah, that's it.
FAST, yeah.
Yep.
So that's a good one. It's a basic template. And so the way I usually say to do it, if you are not at a point where you have an attorney who's sort of set up your employee option pool, blah, 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 but you're bringing on advisors, which is not an unusual sequence of events. You might bring on an advisor before you even start your company. A template like the FAST allows you to kind of put something in paper between the two of you without locking anything in. You're not ready to say how many shares, you're not ready to, there's a lot of things you might not be ready to kind of say yet, but this will put it down in paper. I think this is kind of what you're looking for. And just as a note there, what I always use as kind of a rule of thumb is, and I've seen, unfortunately, sort of the horror stories out there when people give their advisors way too much equity. 0.25%, so 0.25% of your company. So we're not talking share numbers, we're talking percent. So you have 100% of your company, this is 1/4%, is kind of the standard advisor equity. And you can think of that as maybe about an hour a week of their time over about 2 years. So 2-year vesting where they're giving you about an hour a week. If they're giving you a lot more than that or a lot less than that, you can dial it up or down. But at a very early stage, that's kind of the math.
And then I had one other question about triggering your raise. A lot of people have asked me like, okay, when you're, actively fundraising, send us your deck. And I'm like, is there a prerequisite or can I just say, I'm actively fundraising, here's my deck, give me money, please?
Yeah, it's funny. It does feel, sometimes clients feel like it feels like it should, there should be like the bell should ring and now we're open for business. But no, I mean, it's just kind of once you're ready. I think once you have your deck where you feel like and you might iterate your deck too. Decks will change. You'll go to a presentation and somebody will be like, I didn't see anything about XYZ. And you'll realize you forgot to put that in and you'll change your deck and that's okay. But yeah, once you sort of feel like you have your terms in a good place to go out, and your terms will change too. Let me just say, especially if you haven't raised anything yet, you go out and you're like, wow, I'm not getting a lot of bites. I think I might be at too high of a valuation. And then you might want to bring it down a little bit. But there's no like actual triggering moment. You do want to have your board of your company approve the raise. So you'd have a board consent that approves the raise. You do want to have that happen before you start taking money in. And there are this is another piece. So some lawyers, out there, or some folks don't think it's so necessary, but you really should be, even at a pre-seed stage, reporting your fundraise. So that's just another piece to kind of think about. It's a little bit of like legal, but you report it through, there's an online portal that your lawyers can do it for you, or you can do it yourself where you report your raise.
That's good to know. Do you want to drop that resource? I don't think I knew that.
Yeah, it's Edgar. It's
okay, got it.
SEC.
Just through public, public.
Yeah.
So it's all
Yeah.
public. Got it. Makes sense.
Yeah, I mean, Edgar, I don't have we can look up the URL, but Edgar is basically and every company should create that. You just log in and you get a code, and then your lawyer can use the code to file. It's a pretty simple form when you're raising at this stage, but you indicate how much you're raising, and you're supposed to do it within, I think it's within 15 or 30 days of your first check. I'm sorry, I'm blanking my team knows.
Gotcha. And that would only be relevant if you have external capital? Like not
If you're
something-
bringing in external capital, if you're raising on a note or a safe, you should still be doing it. Yeah. I mean,
Yep.
definitely at your price round, absolutely 100%.
Yeah, of course.
At a safe or a convertible note, I always do it for corporate hygiene. There are some folks that'll say, well, you're not actually selling securities because it's a debt round, but to me, you are still selling securities. So I still do it. It's reporting of selling securities, basically, is the idea.
Yeah, makes sense. Okay, more questions. Let me go back to the chat box as well. Looks like we got, oh, great. Do you consider pre-seed also pre-product or pre-revenue?
Good question. I don't think so. I will say something about the pre-seed, seed, series A terms. They can mean all different things, right? I've had clients say raise, and you see here note or price round on the seed, and those are very different types of raises, and I've seen both. I think pre-revenue, the problem with pre-product and pre-revenue, if you're both, it's going to be hard, unfortunately, to get a lot of outside funding. That's probably really truly friends and family, and that's not even, I think that's before we even get on here, and it's really hard. I mean, that's where it's really hard to start getting money. Angels are going to want to see some traction, even if it's just, our product's out there, and in our beta, we had 25 people use it and they all used it for an hour a day. I mean, whatever your product is. If you're absolutely pre-product, pre-revenue, it's going to be hard to show anybody that you have, unless you're, look, if you're a founder that's had some good exits before, you can absolutely raise pre-product, pre-revenue. But I think other than that, it's going to be pretty tricky.
Yeah. And if you're doing that friends and family round and it's still considered external capital, like you would still recommend the same motions that you would recommend, even if it were an institutional VC or an institutional investor.
Yeah, and that's where friends and family is where I most often will see like unaccredited investors and things like that. So it's
Right.
still important to follow those same. Yeah, I would still put a safe note, all the same stuff. Yeah. So I mean, I guess in theory it's pre-seed, but it's just coming in from friends and family versus outside, folks that you don't know.
Makes sense. Okay. I'm just going through to see if there were others. Guys, feel free to chime in as I kind of.
And friends and family, while Rochelle's looking, I will say, is also like, you're not looking at a 12-month runway. I think you're looking at the bare necessities to get your company off the ground. And that way you're selling it very cheap. It might be at $2 million bell cap or something, really cheap, but you're trying to raise, $50,000, $30,000, just
Right.
the bare minimum you need to get that product out in the market so you can start showing it to folks and get a couple, users and use case so you can get to that next round.
Right. Yeah. I mean, you could almost argue that there could be like a smaller one that's like, especially for, for some founders where that friends and family round, or if you don't have access and you're really raising from accelerators and you're only getting that 100K, right? Like, so the thought of 2 million, you're like, well, I'm just trying to take a shot. I'm just trying to, get a chance at proving that there's something here and it's a concept now and I need to get to MVP. So I think that could be an addition to this slide to just like flesh out
Yep.
like, what it look like at the friends and family stage in or much smaller mini rounds. All
I
right.
have one more question around LLCs.
Please. Go ahead, Nancy.
I was just wondering, can we put it as like do a safe note, but based on the safe note and getting the cash, then we incorporate? Because like to incorporate, there's a cost to it. So I just, can you put those together? Because there's a lot of things you said we can't do as an LLC.
Yeah, you can raise as an LLC on a convertible note. What I would do in that situation is raise on a convertible note as an LLC and then do your conversion, because otherwise you're basically asking folks to write a check before you put the safe note in front of them. And if you have people that are okay with that, it might be kind of complicated to paper for the company. What I have seen at a price round, I've seen that part of the closing of the price round is the C Corp conversion, and that all happens together. So we close everything at once, the new corporation, the closing of the price round, it all happens at one time. But with a safe, if you need rolling capital, you should probably do a convertible note. So you might want to do like a small convertible note round, do the conversion. I mean, a C Corp conversion, you're not talking I mean, I understand it small dollar amounts can feel like a lot, but it shouldn't be more than, I don't know, $5,000 to $8,000. So maybe there's one investor that you could give a convertible note to. They could give you, $20,000 or something. And then maybe once the conversion is done, you could go out and raise on a safe if that's what you wanted to do. I mean, there's a lot more nuance there that's probably specific to your company.
Great. Well, I looked back at the questions. We had most of them answered. There was a question I think is very relevant to this audience, and you and I talk about this a lot. Just is there anything specific that you typically do see with, let's say first-time founders, just kind of mistakes because they just don't know what they don't know, right? Or just setting themselves up for success to say, this is my first time doing it, or I haven't had access and opportunity, or I'm a female founder, or, a Black founder. And I don't see a lot of founders like me who have gone through this and I don't know who to ask. So any sort of advice and tips you would share with the group about just things to keep in mind, or the one thing to keep in mind as you're going about this process, and in addition to knowing that you're not alone because you have folks like our team and you to support them.
Totally, exactly. I do think this unaccredited investor piece is a big one, unfortunately, because that can cost you a lot in legal fees to clean that up. I think also there's an IP. We didn't talk about IP, but one thing I will say, just like one takeaway for IP, is to make sure the IP is locked up in the company, not in the individual folks. So if people are helping create content for your company, whatever that might look like, that could be a technology, that could be, social media, whatever it is, that they sign. Usually I like to use a PIIAA or PIA, PIAA, PIIA. There's like a lot of acronyms because it depends on if it's an invention and assignment agreement. Anyway, so you can use a template like that. There are other mechanisms, and it can get a little more complicated and need a lawyer, or that if there's employment agreements or independent contractor agreements, anything that makes sure that all of that IP is owned by the company. I think that's really important. Those folks will come and go, and you're going to be at your Series A, and you're going to need to rep and warrant that all the IP is owned by the company, and you're going to lay awake at night. Oh God, that guy from wherever that I met that was doing the IP, I never got him to sign the thing. How am I going to find him? And you don't want that on your conscience.
Yeah. I appreciate you saying that, but just generally the idea of just wrangling investors is something that we didn't talk about. It's like the administrative piece of it all that can keep founders up at night when they have, a lot of investors on their cap table. So much to discuss on this topic. Okay. One quick question I will ask because it came up was about social media. Are there any things to keep in mind if you want to just publicize that you're fundraising?
Such a good one. And I'm glad that came up. It's a good last one to keep in mind as well. So again, just touching on SEC guidelines. As an early stage company, as a eventually a venture-backed company, or maybe already a venture-backed company, you do not want to fall into the SEC reporting world. You want to continue to avail yourself of an exemption to reporting. One exemption bucket we put our companies in as lawyers in this space requires that you do not publicize your fundraise. So that means you're not out there posting that you're raising. You can say things to your direct friends, to your direct communities, closed communities, that sort of thing. Absolutely. Share your deck, share it with strangers that friends know. I'm not saying it has to just be people you know, but you can't go out there broadly and post it on social media. Exactly. There you go.
Right. Yeah. There is definitely a nuance to soliciting though. I mean, I've seen founders
There's
do
a
it,
total nuance.
Certainly a nuance to it, but something to keep in mind as well. Yep. So it's a really great question. And great. So thank you so much, Wendy. I mean, we definitely could have used, another half hour. We should have you back for diving in deep on dilution and even looking at a term sheet with founders. I think that would be awesome. So hopefully we could do a part 2 and Wendy might be willing to dedicate some of her time because we're starting a new sort of follow-up to these sessions where we allow SVB clients to book one-on-one time with some of our experts. So please follow up on that. I love these emojis. Please take the survey, 15 seconds. It would mean the world to get your feedback as we continue to plan these. And thank you for your time and your engagement. This was awesome.
Thank you, SVB, for having me. I dropped my email and my website, which is coming soon. Our brand hasn't really launched. The website's still coming soon, but you can sign up to get our newsletters. And it was great. Thank you so much. Thanks, Rochelle. It's a pleasure to be with you as always.
Good times. Thank you. Please take the survey. We'll stay here for anyone who wants to copy it. Thank you.